Welcome to the Radio Revenue Podcast. Imagine you want to buy like a $100 million apartment building.
Okay, sounds nice.
Right. But instead of paying with cash, you use this massive legal loophole to essentially print your own tax-advantaged currency.
Mm-hmm.
And by doing that, you completely avoid these massive, immediate capital gains taxes. I mean, it sounds illegal, right? Or at least like something out of a shady Wall Street thriller.
Yeah, it sounds like total fiction, but it actually isn't. It's exactly how the biggest corporate landlords in America are operating right now in 2025.
Which is exactly what we're doing today. We are opening up the 2025 Form 10K for Equity Residential, which trades on the New York Stock Exchange under the ticker EQR and its operating arm, ERP Operating Limited Partnership.
Right, ERPOP.
Exactly. So our mission for this deep dive is to decode this massive corporate filing and uncover the just absolute secrets of the U.S. rental market.
Because, this filing is far more than just a balance sheet. When most of us look at a gleaming high-rise apartment building with, the glass balconies and the nice landscaping, we just see bricks and mortar.
Yeah, just a place where people live.
Right. But if you know where to look, you're actually staring at this highly tuned financial and sociological engine. It's a literal blueprint of modern American living.
Oh, absolutely.
It tells us exactly how, why, and where America's top earners are choosing, or honestly, being forced to live in 2025.
And that is incredibly relevant to you listening right now, whether you are agonizing over renewing your current lease or desperately trying to scrape together a down payment to finally buy a house.
Good luck with that right now.
Right, seriously.
Yeah.
Or maybe you're just insanely curious about where the real estate market is heading. This deep dive is going to be your ultimate cheat sheet.
We're basically looking at what the smart money is doing.
Exactly. And the scale here is just, it's difficult to wrap your head around. We are talking about an operation that controls over 312 premium properties.
Yeah.
That's more than 85,000 apartment units across the country. I mean, that is like acting as the landlord for an entire mid-sized city.
It is a staggering footprint. But to truly understand how they wield that kind of power over 85,000 units, we can't really start with the renters.
Right. We have to start with the structure.
Exactly. We have to start with how the company legally holds these buildings. The corporate architecture of EQR is, well, it's the fundamental engine that gives them this massive competitive edge in the market.
Okay, let's unpack this for a second, because reading through the first few pages of this 10K, the structure of this company is basically a corporate matryoshka doll.
I love that analogy. It's a doll inside a doll.
Right. You have the outer shell, Equity Residential, or EQR. That is a Maryland Real Estate Investment Trust, a REIT. That's the painted shell of the doll that you see trading on the stock exchange. But twist that shell open, and inside you find ERP Operating Limited Partnership. ERPOP, that's an Illinois limited partnership.
The solid wooden core.
Exactly. EQR owns 97.6% of ERPLATS and acts as its general partner. But, and this is the crazy part to me, EQR doesn't really do anything itself.
No, not really.
It's ERPOP that actually holds all the assets, conducts the daily operations, takes on all the debt. EQR just issues equity and funnels the money down to the partnership.
What's fascinating here is the specific mechanism of why they use that nesting doll structure. Because it isn't just to generate, extra paperwork for corporate lawyers.
I'm sure they appreciate the billable hours.
Oh, definitely. But it is what's known in the commercial real estate industry as an UPREIT, Umbrella Partnership REIT.
Okay.
And it functions as this incredible strategic weapon for acquiring new premium properties.
Wait, how does that actually work in practice, though? Why is an UPREIT a weapon?
Well, it all comes down to the tax code.
Yeah.
Let's make it concrete. Imagine a family that bought a highly valuable, say, 50-unit apartment complex back in 1985.
Okay.
Over 40 years, that property has appreciated massively in value, right? But they've also fully depreciated it for tax purposes.
So their cost basis is basically zero.
Exactly. So if Equity Residential comes along today and offers to buy that property for $50 million in pure cash, that family is going to be hit with a catastrophic capital gains tax bill the second the wire hits their bank account.
Right, because the IRS wants their cut immediately on 40 years of gains. It's a massive taxable event.
Precisely. So what happens? A lot of families just refuse to sell. They hold on to it. But because of this UPREIT structure, EOPOP can walk in and offer that family something totally different.
The OP units.
Yes, OP units. These are partnership interests in ERPP itself instead of cash. They essentially trade the physical building for shares in the massive partnership.
And because it's an exchange of partnership assets?
It doesn't trigger the tax bomb.
That is wild.
It really is. The seller just defers the recognition of that taxable income. They convert their single, aging, illiquid building into a fractional interest in a massive, diversified, professionally managed portfolio of 312 properties.
Oh, wow. So they get the cash flow from the dividends of the OP units, they avoid the immediate tax nightmare, and then, what, they can cash out later?
Yeah, down the road, if they ever actually want cash, those OP units can eventually be exchanged one for EQR common shares.
Yeah.
So for equity residential, this structure is essentially a tax-advantaged currency they can just print to convince stubborn owners to sell to them.
Instead of to a competitor who only has cash. That is brilliant.
It is a huge advantage.
But, I mean, having a brilliant tax-advantaged engine to buy buildings is entirely useless if you can't fill them with people paying top dollar.
Absolutely. An empty building is just a liability.
Right. And reading this 10K, EQR isn't just looking for anyone with a pulse and a security deposit. They are aggressively filtering for a very specific type of American.
The target demographic is affluent knowledge workers.
Yeah, they explicitly name professionals in STEM, so science, technology, engineering, and math, as well as the financial, medical, and legal fields.
And they are riding some massive, just undeniable demographic tailwinds to fill those units. First off, you have Generation Z, which is a cohort of roughly 71 million people who are actively entering their prime renter years right now.
That's a huge wave.
It is. But right behind them, you have 74 million millennials who are remaining in the renter pool for much, much longer than their parents or grandparents ever did.
And the 10K spends a lot of ink explaining why. I mean, the cost of single-family homeownership right now is absolutely staggering.
They're prohibitive.
Yeah, you have massive down payment requirements, high interest rates, and this bizarre dynamic of low housing inventory simply because existing homeowners refuse to sell.
They don't want to give up the 3% mortgage rates they locked in years ago.
Exactly. Now, the corporate report spins this beautifully. They claim this dynamic is keeping high-earning professionals in apartments for, quote, lifestyle reasons.
Right, the lifestyle.
But I have to push back on that corporate narrative. I mean, are these affluent workers truly renting for the lifestyle and the nice gym downstairs, or are they effectively trapped by the math?
I think you're absolutely right to call out the corporate spin there. The 10K paints this as a breezy lifestyle choice, like they just love the convenience. But when we connect this to the bigger economic picture, the math tells a much darker story about the modern American dream.
Right.
Even a highly paid STEM worker in 2025 is doing the calculations. A 20% down payment on a $1.2 million starter home in Boston or San Francisco.
Which is just a normal house there.
Yeah, a basic house.
Yeah.
That requires $250,000 in liquid cash, plus the monthly carrying costs of an 8% mortgage. They aren't renting a $4,500 apartment just because it's fun.
They're renting it because they literally have no choice. The starter home is mathematically out of reach, even for the upper middle class.
Exactly. But honestly, whether these renters are trapped by the math or actively choosing the flexibility, the outcome for equity residential is identical.
The rent check still clears.
Precisely. EQR realizes they aren't just selling a roof over someone's head. They are selling a premium, flexible lifestyle to a demographic that has incredibly high disposable income, but is entirely priced out of coastal homeownership.
And because these specific renters earn high salaries and are not rent burdened, meaning the rent is a reasonable percentage of their take-home pay, EQR has the leverage to push rents higher during economic booms.
While facing a much lower risk of eviction defaults during downturns, it's a very insulated tenant base.
Right. And because EQR specifically targets these high-earning knowledge workers, the financial performance of their 312 buildings is completely tethered to the regional health of those specific industries.
Yes, the geography is huge here.
And looking at the raw 2025 numbers, that highly targeted strategy paid off. Their overall net income grew from $1.07 billion in 2024 to $1.15 billion in 2025.
That's a solid jump.
It is. And their physical occupancy across all these units remains incredibly strong at 96.4%. But when you look under the hood geographically, it's really a dramatic tale of two coasts.
The regional disparities are stark, and they tell us so much about the broader economy. Like San Francisco and New York were their absolute best-performing markets in 2025.
Which feels completely counterintuitive considering the Dune Loop narratives we heard about those specific cities just a few years ago. Like, everybody was leaving, right?
It does feel backward, I know. But the data in the 10K exposes the reality on the ground. We're seeing a very clear, massive tech rebound in San Francisco.
Okay.
You combine that tech hiring spree with aggressive return-to-office mandates from large employers and pair it with a notoriously low supply of new competitive housing in both New York and San Francisco.
And you have a perfect storm for a landlord. High demand, low supply, and wealthy tenants equal incredibly strong pricing power.
Exactly. Seattle is also showing a major recovery for the exact same reason.
But then you look at their struggling markets, and the reasons are so hyper-local. Washington, D.C., for example, slowed down heavily in the second half of 2025. And the reasons listed are totally unique to that city's economy. They cited uncertainty from federal government cuts, a highly publicized government shutdown, and massive National Guard deployments.
Think about the psychological impact there.
Right. If you are a high-level government worker or a contractor and the government shuts down, your paycheck is paused. You aren't going out that weekend to sign a 12-month lease on a premium luxury apartment. You hunker down.
Yeah, you freeze your spending. And that local volatility is exactly why EQR expanded into the Sunbelt in the first place.
Right, to diversify.
But those expansion markets, places like Atlanta and Dallas, faced their own unique headwinds in 2025. They experienced a massive glut of new competing apartment buildings.
Because it's easier to build there.
Exactly. It's economics 101, supply and demand. Sunbelt cities make it very easy for developers to build. So too many new luxury buildings meant EQR had a much harder time pushing rent increases.
They had to offer concessions, right? Like 1 month free rent.
Yep. Though the report does note those markets are finally starting to show signs of improvement as that new supply gets absorbed by population growth.
Here's where it gets really interesting to me, though. Reading this geographic breakdown, why does the report explicitly state that Los Angeles is facing ongoing challenges and dragging down their overall performance?
That's a great question.
Because LA is currently gearing up to host the 2026 World Cup and the 2028 Olympics. You would think that market would be absolutely exploding with demand, infrastructure investment, and new renters right now.
It's a completely logical assumption, but it perfectly illustrates how microeconomies almost always trump macro events in real estate.
Really?
Yeah. The report points out that Los Angeles is dragging specifically because of a muted entertainment industry.
Oh, the strikes.
Exactly. A global sports boom happening 1 or 3 years in the future doesn't help pay the rent today if Hollywood isn't hiring.
That makes total sense.
If the writers, producers, and visual effects artists who make up that local high-earning renter demographic are facing industry strikes or a production slowdown, they simply aren't upgrading their apartment.
They're just staying put.
Right. The immediate local employment engine matters infinitely more to residential real estate than a global event on the horizon.
I love that. I mean, the tenant needs a paycheck this Friday to pay the rent on the first of the month. They do not care about the Olympics 3 years from now.
Exactly.
So to keep these demanding, highly stressed tech, finance, and entertainment workers happy across all these wildly diverse markets, EQR has had to radically modernize how they manage their properties.
Oh, yeah. It's not just the superintendent fixing leaky pipes anymore.
Not at all. Segment 4 of this 10K outlines a massive structural lean into property technology and data analytics to maintain that 96.4% occupancy rate.
And it's not just tech for the sake of tech, right? It's tech designed to squeeze out operational inefficiencies.
Yes. Instead of just listing what they do, look at how it changes the renter experience. Like, they are deploying self-guided tours. If you want to view an apartment on a Sunday morning, you don't have to schedule a time with a leasing agent who, follows you around with a clipboard.
Right. Pressure selling you.
Exactly. You use your smartphone to unlock the empty unit and walk through it yourself. They are using AI to instantly respond to leasing inquiries at 2 a.m. But the most fascinating part to me is their use of predictive data analytics to, quote, predict resident outcomes.
Yes. That is where the AI becomes a true financial tool. Predicting resident outcomes means the software is analyzing thousands of data points to figure out who is going to move out before they even give notice.
Wait, predict outcomes, like a minority report for renters?
Basically, yeah.
Yeah.
It might flag that a specific unit has had, say, 3 HVAC maintenance requests in the last 6 months, and the tenant paid their rent 2 days late last month. The AI connects those dots, determines the tenant is a high flight risk, and might prompt the management team to proactively offer them a specialized renewal concession to keep them in the building.
Wow. It turns property management from a reactive business to a proactive science.
Exactly. And it extends beyond just the daily resident tech. They have a massive corporate responsibility and climate risk program.
Right, and again, this isn't just greenwashing PR. They are actively analyzing climate data and future hazard exposure to ensure their physical buildings are resilient to a low-carbon economy.
Mm-hmm.
In practical terms, that means analyzing floodplains and moving critical electrical infrastructure from the basement to the third floor in coastal cities, or evaluating the walkability and transit access of a building to ensure it remains attractive to renters who just don't want to own cars anymore.
Because a flooded lobby in Miami ruins the yield on that building for the entire quarter. The property manager of 2025 is part AI concierge, part climate risk assessor, and part data scientist.
Yeah. But honestly, what surprised me the most in this financial document wasn't the AI or the climate data. It was the intense focus on human capital.
Yes, the employee metric.
For a company deploying so much automation, their metrics on their 2,400 human employees are staggering. In 2025, they achieved an 87% employee engagement score and an 85% inclusion index score.
Those are exceptionally high numbers for any large corporation, let alone a real estate operator spread across multiple state lines and local cultures.
And they back those surveys up with hard benefits. They offer 100% preventive healthcare coverage, and this blew my mind. Their 401k participation rate is over 90%. Why? Because the company enforces an automatic enrollment sweep at 8%. They are aggressively forcing their employees to build personal wealth. Why does a corporate landlord care if their maintenance staff has a robust retirement account?
Because they understand the direct synergy between high-tech and high-touch. By allowing artificial intelligence and centralized software to handle the soul-crushing mundane tasks like answering basic emails or automatically routing maintenance tickets, EQR can focus its actual capital on employee well-being.
Right.
They even maintain an employee crisis relief fund to provide grants during personal hardships. From a pure cold business perspective, a supported, financially secure, and happy staff directly translates to better, more empathetic customer service.
And better customer service leads to lower resident turnover. It is a closed-loop operational ecosystem.
Exactly.
But relying on clever AI and high-earning tech workers doesn't make EQR bulletproof. We have to balance this rosy picture of 87% engagement scores with the raw structural financial risks outlined in the 10K.
And there are plenty of them.
Yeah, and the biggest number that jumps off the page is the debt. The company is carrying $8.17 billion in total debt.
That is a colossal liability.
It is.
But the structure of that debt is where the real story lies. Over 90.5% of that debt is strictly fixed rate.
Okay, so they're insulated.
Exactly. That means even if inflation spikes again or the Federal Reserve wildly changes interest rates, EQR's interest payments on $7.4 billion of that debt will not budge a single cent. Furthermore, they maintain $1.9 billion in readily available liquidity.
And the most crucial stat to me was their unencumbered real estate.
Oh, yeah.
Over 90% of their properties, which totals a staggering $27.4 billion worth of real estate, is completely unencumbered by mortgages.
Which is wild.
Right. To put that in normal human terms, imagine you own a $30,000 car outright with absolutely no auto loan. If you suddenly lose your job, you can easily go to the bank and borrow cash against the clear title of that car to survive the year. EQR is doing that exact same thing, but with $27 billion worth of apartment buildings. They own them free and clear. If the credit markets totally freeze up, they have this massive pool of clean collateral they could borrow against.
But there are still significant vulnerabilities, particularly in their operational revenue model. And the biggest one is lease duration.
Yeah.
Almost all of their residential leases are for 12 months or less.
Now, wait. If you are renting right now, you know the absolute anxiety of that 12-month lease renewal hitting your inbox.
Oh, absolutely.
The company frames these 12-month leases as a massively positive thing in the report. They argue it's a great way to raise rents quickly during an inflationary period. If their operational costs go up, they only have to wait a few months to bump up the rent on a newly signed lease to match it. EQR basically relies on that renewal anxiety. But doesn't that inherently mean if the economy tanks, say the tech sector in San Francisco has massive unexpected layoffs, their revenue could absolutely plummet in a matter of months?
Yes.
Because a commercial landlord who leases office space usually has a 10-year lock on their revenue. EQR has to basically resell their entire inventory of 85,000 units every single year.
That is the exact tension at the heart of their business. You've hit on the inherent volatility of residential real estate.
Right.
The short-term lease is a vicious double-edged sword. It captures the upside of inflation beautifully, allowing them to constantly reprice their product. but it exposes them instantly to sudden economic downturns.
So if the knowledge workers lose their jobs, the buildings empty out fast.
Exactly. And that exact vulnerability is the why behind their obsessive financial structure. It explains why EQR maintains such a fortress balance sheet.
Ah, it all ties together.
It does. They keep their debt largely fixed and leave $27.4 billion of their properties unencumbered exactly because they need a massive shock absorber. They know their revenue can fluctuate rapidly due to those short-term leases, so they ensure their underlying capital structure is virtually indestructible.
It is all completely connected. The Matryoshka doll structure of the UPREIT legally defers taxes to grow the portfolio faster than competitors. The AI predicts resident outcomes, and the human capital investment keeps the affluent renters happy, maintaining that 96.4% occupancy. And the unencumbered balance sheet protects them from the terrifying reality that every single tenant could technically walk away within 12 months. It really changes how you look at that gleaming high-rise when you walk past it, doesn't it?
It really does.
It isn't just a building, it's an incredibly complex, resilient machine designed to simultaneously extract and protect capital.
It truly is. And, it leaves us with a critical, somewhat provocative thought to mull over as we wrap up today.
Oh, what's that?
Well, we've seen how massive UPREITs like EQR are continuing to consolidate premium housing in our major cities. They are deploying advanced artificial intelligence to perfectly optimize rental rates down to the absolute maximum dollar a tenant can bear.
Right.
And they are catering almost exclusively to the highest earners in our society. So if this macro trend continues, what does the future hold for the traditional American dream of homeownership?
That's a grim thought.
If the underlying economics of buying remain so deeply skewed, will the very concept of the starter home eventually be entirely replaced by the starter luxury rental? It is a profound shift in how generational wealth is built or, not built in this country, and it's something for you to watch very closely as the housing market continues to evolve.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.